Bob Diamond, what do you remember of those days?
I think that was like the next year in 2009, and all bank stocks were very, very weak. And if we look back at that period, that first quarter of 2009 was the deepest and darkest recession that we had seen since the Great Depression. I think as we look back at it today, it lasted 3 to 6 months, but the severity of it was real.
Are we still paying the consequences of the financial crisis now? I've heard everything. Nouriel Roubini was saying, well, actually, populism is because of the financial crisis. This kind of stagnant growth is because of the financial crisis. What do you see as the real consequences left?
I think my worry is how do we move ourselves away from the appropriate measures that were taken around monetary policy and fiscal policy, and how do we begin getting to a more normalized level of interest rates without spooking the markets. And against the backdrop that we're talking about, there's $8 trillion in U.S. corporate debt that will mature between now and 2020. So if you see the environment, if you kind of weigh all of those things with a significant amount of ammunition used from monetary policy and fiscal policy, a need to get rates higher back to a more normalized level, and all of the debt that is ready to mature in the next couple of years, we have a recipe for issues. And how do we manage through that, I think, is the single biggest impact of the financial crisis today.
When you say issues, Bob, is it crunch time for the economy, or is it actually a huge market correction?
Well, I think that's the question, and I think there's no question that we have to continue raising rates and get back to a more normalized level, and we also have to be conscious of the impact on that on other factors such as the maturity of debt.